Hey there, and welcome to The Explainer. We all dream out making money while we sleep, right? Well, today we're going to explore how to do just that. We're staging a passive income duel. In one corner, we've got investing in businesses, and in the other, investing in actual buildings. Let's see who comes out on top.
Okay, so let's get right to the heart of it. This whole idea of passive income. What does it even mean? It's pretty simple, really. It means you own stuff, we call them assets, that generate an income for you without you having to work for it every day. It's not about you getting another job. It's about your money getting a job of its own.
All right, it's time to introduce our two heavyweights. In the blue corner, we have Dividend ETFs. Think of this as owning teeny tiny slices of hundreds of different companies all at once. And in the red corner, we have rental real estate. This is about owning a physical building, a place that someone actually calls home. So first up in the ring, let's talk about these dividend ETFs. Just imagine a giant basket, and inside that basket are little pieces of hundreds of really successful companies. The kind of companies that share their profits with the people who own them? Well, an ETF is like buying that entire basket with just one click. You don't have to worry about picking the winners. The fund does all that work for you. And here's the best part. You're not the one out there squeezing lemons or building the stands. Nope. You just own a tiny little piece of this huge empire, and every time they make a profit, a little bit of that cash automatically flows right to you. It's income and safety in numbers, all rolled into one.
Now for our other contenders, something you can literally touch and feel. We're talking about owning actual property, a house, a condo, you name it. You're providing a fundamental need, a roof over someone's head. Yeah, it's a really straightforward exchange when you think about it. You own the place, someone else pays you for the privilege of living there, and that rent check becomes your income. It's one of the most direct ways to see an asset you own generate a paycheck for you, month after month.
Okay, analogies are fun, but let's get down to brass tacks. Let's talk money. To make this a fair fight, let's pretend you have $100,000 ready to invest. What happens if you put it into one of these strategies? Let's see how it plays out. All right, here's a super simplified look, side by side. With the ETF, your whole 100 grand goes right into the fund. Simple. But what's really interesting with real estate is that your 100 grand isn't the whole story. It's actually a down payment, which lets you borrow the rest from a bank to buy a much bigger, more expensive property. So while both can generate the steady income, how they get there is totally different. So that $583 a month? That is about as hands-off as it gets. It's your cut of the profits from massive companies, and it just shows up in your account. You literally don't have to do a thing. Now, over on the rental side, we see $700. A little higher, right? But, and this is a big but, that's what we call cash flow. That's the money that's left over after you've paid the mortgage, the property taxes, the insurance, and put some money aside for when the water heater inevitably breaks. It's more money, but it definitely comes with more responsibility.
Okay, but you and I both know that the monthly income number doesn't tell the whole story, does it? To really get a feel for these two, we need to look at the official scorecard, the pros and the cons for each one.
Let's start with the strengths. For ETFs, it's all about simplicity. You can buy in, get a super diverse portfolio instantly, and if you need the cash, you can sell in seconds. But real estate, well, it has a superpower called leverage. You get to use the bank's money to control a huge asset, which can seriously amplify your returns. Plus, hey, you're the boss, you have total control over your property.
But, of course, every hero has a weakness, right? There are always trade-offs. With ETFs, your income can go up and down with the stock market, and you have zero say in how those companies are run. And real estate? Well, it demands work. You have to manage it. It's way harder to sell in a pinch. And you have to be ready for that late-night call about a leaky toilet. This is where things get really interesting. Taxes. Dividend income from an ETF is taxed pretty simply. But real estate? Oh, real estate has a few tricks up its sleeve called deductions. You can subtract the cost of things like mortgage interest, repairs, and property taxes. And then there's the big one. Depreciation. This is a tax break you get for the building's supposed wear and tear. Even if your property is actually going up in value, it's a huge advantage. So, after all of that, who wins the duel? Who takes home the championship belt for passive income? Well, as you've probably figured out by now, the real answer isn't quite that simple. It really just boils down to you. What kind of person are you? Are you a set-it-and-forget-it type who just wants simplicity? Or are you someone who likes to get your hands dirty, have more control, and take advantage of those powerful benefits like leverage and tax breaks? Maybe we framed this whole thing wrong. Maybe it's not a duel at all. The real goal isn't to pick a single winner. It's to build a whole system of assets that makes money for you. And for a lot of savvy investors, the strategy isn't ETFs or real estate, it's ETFs and real estate.
And that's really the big idea we want to leave you with. Instead of seeing these as rivals fighting in a ring, think of them as two totally different but equally powerful tools in your financial toolkit. The most important question isn't which one is better, but how could you potentially use them both to work together for you?